Hello, this is Dan Wiener, Chairman of Advisor Investments, with another Advisor You Can Talk To podcast. I'm sitting with Jeff Demaso, Advisor Investments Director of Research here in New York, and Brian Mackey, his Deputy Director of Research in our Newton offices, and we're going to talk about our top 10 favorite myths about investing. Many of these myths ultimately come down to trying to predict the direction of the stock market. They're timing myths. Brian, I'm going to start with you because you told me one of your favorites has to do with football and the famed Super Bowl indicator. The Super Bowl is long over, and yes, the Patriots won again. That's bullish for their Boston fans, but why is it a favorite of yours, and what's the myth?
So I am excited about the New England Patriots, and I'm excited that they won this year. But let me take a step back and talk about the Super Bowl indicator, which states that a team from the National Football Conference, or the NFC, when they win the Super Bowl, the stock market will be up that year. However, when an AFC team wins, the stock market should be down that year. Now, this is a favorite of mine because we all know as investors, you would never use the Super Bowl to try to predict the stock market. So it's kind of one of these silly myths out there, but it continues to make headlines even to today. And so studies have shown that the indicator has actually been right about 80% of the time, which sounds fantastic. Why wouldn't you want to invest in something that's got an 80% hit rate? However, if you just guess that the stock market would be up every year, you'd also be right about 80% of the time. So the indicator is definitely a myth. It doesn't have a better batting average, so to speak, than regular guessing. And I think the best example of how this indicator got it wrong was in 2008 when the Giants played the Patriots and the Giants won. Now, the Giants, they're an NFC team, which states that if the indicator was right, the market should have been up in 2008. Now, we all know how that ended. It ended pretty poorly for both the stock market and the New England Patriots. Although I will say in that game, there were a couple bad calls, a couple bad plays that maybe the Patriots should have won. However, the Giants won and the indicator was wrong, and wrong in a big way. Now, thankfully, this is a myth because I'd never want to have to choose between rooting for the stock market or rooting for the New England Patriots, which is an AFC team. But now that we know that it's a myth and that the New England Patriots won this year and the stock market continues to do well, we can safely ignore this one.
You Patriots fans are all the same. And you stole some of my thunder. The Super Bowl indicator ties in with another myth, the January effect. And this one, in essence, says, as goes January, so goes the year. If stocks are up in January, then they're going to be up over the next 11 months, giving us a positive year. And if they're down in January, then stocks will be down in the ensuing 11 months, and that'll mean a year in the red. Well, I also hate to be a bearer of bad tidings, but I went back to 1940, almost 80 years, and the January effect success rate is about 69%, which means it's correct a little more than 2 years out of 3, or better said, it's wrong 1 out of 3 years. If you look back over just the past 10 years, the January effect has only been right 3 times, which is much worse than average, and that's been during a bull market. If you sold out of stocks because January was in the red, you probably were pretty red-faced when you saw how the market did. And, Brian, as I said, you stole my thunder a little bit here because since 1977, which was the first full year after its inception, Vanguard's 500 index fund has been positive in 34 of the last 42 years, or 81% of the time, that 80% number that you came up with. So if you simply started each year assuming stocks would be higher, you'd have had a better success rate than following the January effect. Jeff, you have your own favorite timing indicator or myth, don't you?
I do. It's called the sell in May and go away trading strategy. And so the idea is if you follow the strategy, you're going to own stocks from November through April. And then May comes and you sell your stocks and go to cash. And you stay there from May through October. So you rotate between stocks and cash every 6 months. And the myth here is that by doing this 6-month rotation, you can capture most of the market upside and avoid most of the market's pain. Now, unfortunately, like this strategy, like the two that you've already mentioned here, I think it can safely be filed under the too good to be true bucket. I mean, if only investing were so easy, it's just following the calendar every 6 months. So where did the sell in May myth come from? if you run the numbers, and we did them, on the surface, it looks pretty good. So if you compare an investor who just bought and held Vanguard's 500 index fund since October 1976, pretty much the fund's inception, it returned 10.8% a year. But if you followed the sell in May strategy, you returned 10.3% a year. So 10.8 versus 10.3, those are really similar returns. And the sell in May strategy had less risk. So what's not to like? Well, this strategy has a super low hit rate, super low success rate. You guys were talking about success rates of 70, 80%. Well, the sell in May strategy only works in 1 out of 3 years, and it goes for these long periods without working. So from 1991 through 1999, the big bull market of the 90s, this strategy only worked one time. And then it paid off in 2000, but how many people stuck with it? Similarly, it's only worked once since 2008. So I doubt many people, if they were following this in the first place, have stuck with it. In other words, there's this big difference between doing a back test and running these in Microsoft Excel in a spreadsheet and actually trying to follow them in real time with real dollars. So once again, these are just too good to be true.
Jeff, isn't it the case, though, that the idea of selling in May and then buying back, I believe, in November, that over time, on average, the market actually does go up between May and November? I mean, that's the big issue here, that you're not actually seeing the market go down between May and November. It's just possibly going up less.
No, exactly. But it's that really low hit rate again. 1 out of 3 years it only worked. So the idea is, usually the market goes up in those summer months.
Yeah. I think we've hit this market timing mythology pretty hard with 3 different myths. Brian, for those people who've looked for alternatives to stocks, and I guess when people are market timing, part of what they're doing is saying, I don't want to be in the stock market, so I got to put my money somewhere else. Maybe there's some people who have some myths, or there are some myths around the alternatives to stocks.
Yeah, I think the most popular question we get outside of the stock market is gold. What about gold? And the big myth about gold is that it protects you against inflation. So inflation is just consumer prices going up over time. They eat away at your ability to buy the goods and services that you want as an investor. And so you want to own something like gold if it protected against inflation. However, the data shows that there just isn't a great case for that. So really, if you kind of take a step back here, the myth got started in the 1970s when inflation took off and it was in the double digits. It was really scaring a lot of consumers and investors out there. And at the same time, gold did really well. And so if you were living around that time period and you were investing around that time period, you were looking at those two factors and saying, oh, I should own gold to protect against inflation. And the problem is that fast forward to today, and that period in the 1970s is the only period we've had where inflation's got into the double digits over the past 50 years or so. And if you look at a lot of the people that started investing around then, they're becoming retirees now. So a lot of these people are saying, hey, I've saved a lot of money over the years. I just want my money to kind of grow with inflation so I can buy the same goods and services that I want every day. And it's a perfectly reasonable assumption, but we just have the lack of data to justify the fact that it will protect you on the upside when inflation does come around eventually. The real issue is not that gold won't protect you during periods of inflation, but the bigger problem is that it won't give you that return that you need for growth over long periods of time. So I think a great example of the return that you give up by holding gold is comparing the Dow Jones to the price of gold. So back in the early 1980s, the Dow Jones was trading at around 800 points, and an ounce of gold cost about $800 to buy. Now, fast forward to today, and an ounce of gold costs about $1,300 to buy. So it's gone up in value, but the Dow has gone up to 26,000, and that's only including price. So along the way, if you had bought into the companies in the Dow, you also earn dividends as well as price appreciation. So it's not so much that gold is a horrible inflation hedge. It's just that you're giving up too much on the upside to get that inflation hedge.
But it is a terrible inflation hedge. In fact, I have done the math on this $800 gold high point back in the 80s. And even if gold had only matched inflation, it would be at about $2,800 an ounce today, and it's at 1,300. So, and that's just matching inflation, much less protecting against it by doing better.
Yeah, I mean, I always tell investors that I think the stock market is a much better long-term hedge against inflation because if you think about it, what you're worried about with inflation is prices going up. Well, it's companies that are selling you those goods that are increasing prices. And so if you invest in those companies, then you're able to participate in the price appreciation by earning more profits. So there's that benefit.
So gold is one of those alternative myths that doesn't work. You also think there's mythology around real estate, don't you?
Yeah, the other popular question that we get from clients is why should I put my money in the stock market when there's all this great real estate out there that I can buy instead? And I think a lot of investors will say, well, I can't see my investment in the stock market, but I can see the house that I just bought and I can see, the benefit of that. And so the way I look at it is I always try to take a long-term view, and Credit Suisse has some great research on long-term returns of various different asset classes. So they've published work on what the long-term return of stocks, bonds, cash, and real estate is. And they've even looked at other collectible items like art and wine and stamps and things like that. And what they came to the conclusion of in looking at data going back from 1900 up to 2017 was that global equities were by far the highest performing asset class that you could buy. And real estate generated a positive return, but not nearly as much as the stock market did. So real estate can be a good investment. It can go up with roughly the population growth, and it'll go up a little bit with inflation. But over time, the stock market is a much better place to park your money.
Yeah, I think that Credit Suisse data is an extension of the data that Solomon Brothers used to do when Solomon Brothers exist. Bob Solomon used to rate everything from Chinese ceramics to old masters paintings to Ferraris, and stocks always came out as the best investment you could make, and gold, neither gold nor real estate was anywhere near the top.
Hey, Dan, the other distinction to draw there is also between a real estate property that you're investing in to rent out versus the one that you buy to live in. The one that you live in, the home that where you raise your family, that's more of a lifestyle purchase. It's something that you're consuming. So there's a distinction to make as well between rental property and where you live.
Oh yeah, absolutely. I call buying real estate to live in an investment in your lifestyle. It's not an investment the way we expect to generate a high total
Yeah,
return.
that's a great way to look at it.
Also, with real estate, as I've told some of our clients, they don't have a little neon sign on top of your house showing you the price of the house every day. There's very little liquidity. You don't know what the price is until someone comes along to buy it. Along the lines of investments that people often seem to turn their noses up to, uh, or at least we've turned our noses up to gold and to real estate. But in this age of the exchange traded fund or the ETF, the good old mutual fund seems to be falling out of favor. Mutual funds go back to the 1920s. The first fund, the Massachusetts Investors Trust, was created in the 20s. And one of the myths I often hear is that mutual funds are only for smaller, unsophisticated investors. Real investors buy individual stocks or they buy hedge funds. Um, this is one of those myths that I could spend hours on. And it's also a myth upon which we've built our careers at Advisor Investments. First off, mutual funds are great investment vehicles for all investors. It gives you access to some great investment professionals, portfolio managers who are at the top of their game. They have a very low cost of entry, and they're very inexpensive to run, and they're very transparent, and they have public track records. Virtually none of those qualities exist in the hedge fund world, where, for instance, hedge funds are extremely expensive. They're very opaque. Most of them fail to even match a simple benchmark. And you pay fees of 2% annually, typically, plus you give 20% of your profits back to the people who run them. The only people I think who really profit from hedge funds are the people who set them up. And that's why they called the investors in hedge funds limited partners. You only get a limited return, which leads me to another myth that I think we've done a good job busting over the years, and that is that passive funds or index funds outperform actively managed funds. Again, I could go on for hours on this one, but suffice to say, the myth is based on the average mutual fund manager and the average mutual fund. While it's true the average mutual fund manager hasn't outperformed their index benchmarks or index funds, it isn't because index funds are more diversified, holding more stocks or bonds than the average fund. You know, when you diversify out the way an index fund does, you get as many dogs in your portfolio as you get good stocks. And it's index funds don't do well against the average manager because humans are inherently worse investors than computers. The fact is, it all comes down to costs. Human managers running funds with high operating expenses are at a competitive disadvantage, and the average manager simply can't overcome that expense headwind. But we've found some terrific managers running low cost funds that we believe can outperform. And in fact, they've held up well in the bull market that began in March of 2009, which leads me, I think, Jeff, you have a myth or it's kind of a pet peeve myth about this bull market, don't you?
Oh, I am so tired of hearing this in the media that we are 10 years into a bull market. The implication is always that the bull market has run for too long and that we are due for a bear market. But have we really been in 10 years of a straight, uninterrupted bull market? I don't think we have. But let me back up for a sec and just give you two quick definitions. So when I say bull market, I'm just talking about a period of rising prices, rising stock prices, and it comes to an end with a bear market. And so a bear market is commonly defined as a decline of 20%. So where this myth is coming from is the fact that one index, the S&P 500, has not had a 20% decline since early 2009. So that's 10 years ago. But
Isn't the S&P 500 the stock market?
uh, not quite. There's, over 2,000 stocks in the US market. There's another several thousand stocks outside of the US market. But I mean, come on, that's a fairly arbitrary definition of the market. The 20% line in the sand of a bear market is an arbitrary line as well. So in my book, we've had three bear markets in the last decade. If you go back to 2011, in the midst of the Eurozone crisis and the US debt getting downgraded, the S&P fell 19%, a whisker from a bear market. But everything else was in that bear market. Small cap stocks, mid cap stocks, real estate, foreign stocks, emerging market stocks, take your pick. Everything else was in that technical bear market. Same again in 2015 into early 2016. The S&P 500 did not cross that 20% line, but everything else was in a bear market. And again, in just this past fourth quarter in 2018, similar situation. The S&P came within a whisker of a bear market, but didn't fall 20%, but everything else was. I mean, just think back to Christmas Eve. I bet for most of us that felt like a bear market. So I would love
So,
to see us just stop talking about this 10-year bull
so
market.
you'd rather we all talk about 10 years into an S&P 500 bull market and otherwise not talk about it at all. Is that right?
Yeah, let's either be very specific about it or let's not worry our heads about trying to time the market.
Jeff, some myths are so pervasive they've become accepted practices in the investment industry. You got one you wanted to talk about.
Yeah, let's talk about rebalancing. I mean, rebalancing is just a standard piece of investment advice you hear for investors. It's have a diversified portfolio and rebalance it every year. But I think the idea of rebalancing is really misunderstood. So, rebalancing is the act of periodically bringing your portfolio back to your normal target level. So, maybe you have 50% stocks, 50% bonds. If stocks do better than bonds, it becomes a bigger part of your portfolio. So you sell down stocks to bring it back to that 50-50 level. So what's misunderstood and what the myth is around rebalancing is that it's going to boost your returns because it's supposed to be this disciplined way of forcing you to sell high and buy low. Now, again, we've run the numbers on this every different way you can, and there just is not a boost to your returns from rebalancing. And why is that? Well, it's because more often than not, when you rebalance, you sell stocks, which tend to offer higher returns over time, to buy bonds, which offer lower returns over time. Now, I'm not saying never rebalance. The just understand why you're rebalancing. It's not to boost your returns. It is all about trying to manage the risk in your portfolio.
It's a good point you make that rebalancing almost always generates a sale of stocks and a purchase of bonds. I can't think of many times, unless you're rebalancing on an incredibly uh, short time span, where you'd be selling bonds to buy stocks. I mean, it's only happened a few times.
Right. And those times are going to be very difficult emotionally to do it. It would be in December of 2008 if you just rebalanced every year. In that year, you're going to have to sell your bonds, which have been keeping you, safe and holding your portfolio together, to buy stocks in the midst of that bear market. That's going to be really tough to do.
Yeah, I don't think anybody's going to rebalance then. So believe it or not, we've already hit 9 myths, and we've only got one more to go. Brian, I'm going to throw this to you. You think there's a broad myth in the way investors and investment marketers measure success?
Yes. So one of the big myths out there is what we call success equals beating the index. And so we've talked about a couple different indexes today. The S&P 500, I'll just pick on that one for a while. So just to take a step back, an index like the S&P 500 is designed to track the performance of the broader stock market. So the index's return is considered a proxy for the overall market return in any given year. And some investors will earn a better return than the index, while others will underperform it. And an index fund, something like the Vanguard 500 index, is designed to buy all those stocks in the S&P 500 index. And so what you'll get if you buy the Vanguard 500 index is a return that's pretty close to the S&P 500. Now, a lot of investors out there would probably do better by just buying the 500 index and getting that sort of quote unquote average return. But a lot of us out there think we're above average. There's studies out there that show that most people believe they're above average drivers, that most people believe they're above average in intelligence and above average investors. There's a great quote from Warren Buffett. He was speaking with Bill Gates in front of an auditorium of university students, and he said, look, all of you in here probably realize you can't do what Bill Gates did when he created Microsoft, created this new technology, but everyone in here thinks they can do what I do. And the reality is not a lot of people can do those above average market beating returns that Warren Buffett has been able to deliver over his full career. And the reason why this can be harmful is because when you focus on quote unquote beating the market, getting that above average return, you tend to do things that hurt yourself in the long run. You might buy this hot stock that you heard of the news, or you might buy this mutual fund that is really expensive, but it made it into some article that you read, and you move away from that disciplined approach of just buy and hold and focus on the long term and keep costs low. And so we always try to, when we get clients that ask us about beating the S&P 500, for example, we always try to bring it back to their individual goals. So success, in our opinion, is not beating the index. Success, in our opinion, is reaching your financial goals and being able to spend the money that you have on the things that you want and the people that you love.
But it strikes me that the whole notion of beating the index makes the assumption that you own only stocks. I mean, most of our clients, most investors are not 100% invested in stocks. They're invested
Mm-hmm.
in bonds. They're invested in cash. I know that when I started Advisor Investments 25 years ago, every once in a while I'd get a call from someone who would ask, and this, believe me, this was in the 90s. The markets were going up pretty dramatically. And I would get a call from someone asking me if we could, they weren't going to be piggish, they said. If we could just match the stock market with about 60% of the risk, they would be happy. And I laughed, and then I said, listen, if you can find someone who'll promise that for you, I'll give you my money too. It's just not a reasonable expectation.
Yeah.
All right, so success equals beating the index is our 10th myth of the day. Thank you, both of you, for taking time out of your days to help bust some myths. I know you both have plenty more you'd love to talk about in a future podcast, and maybe we'll do that. In the meantime, this is Dan Wiener, Chairman of Advisor Investments. I've been talking myth busting with Jeff Demaso and Brian Mackey, our Director of Research and Deputy Director of Research, respectively, here at Advisor Investments. Thank you for taking time today to listen to another of our Advisor You Can Talk To podcasts. If you've enjoyed this conversation, please subscribe and review our show. You can also check us out at www.advisorinvestments.com/podcast. We love getting your feedback as well as suggestions for future episodes. If you have any questions or topics you'd like for us to explore, please email us at info@advisorinvestments.com. And thanks again for listening.